Interest rates have been on a tear recently, particularly as the U.S. Federal Reserve has signaled the beginning of what may be a lengthy cycle of monetary policy tightening. Aside from the general increase in interest rates, the yield curve has gotten a lot of attention recently. So what is the yield curve? Why is it important? And what is it telling us? Let's break it down. So the yield curve refers to the differences in interest rates across the Treasury maturity spectrum from the 3-month T-bill all the way to the 30-year Treasury bond and every maturity in between. The shape of the curve can be steep, where the difference in yield between the shorter and longer maturity bonds is significant, or it can be flat, where there is no or little difference between the interest rate investors can earn across the different maturities of Treasuries. Logically, one would expect that this curve would always be positively sloped. That is, that investors would always earn more interest to invest in longer-term bonds. The reason why the yield curve is considered to be important is that the shape of the curve often holds important information about investor expectations for growth and inflation. In prior periods, in fact, the yield curve has had some predictive power when it comes to recessions, and flat yield curves predicted every recession since 1950. Importantly, though, every flat yield curve was not followed by a recession, so we have had some false signals as well. So what is the yield curve telling us now? The yield curve today is very flat. The difference between the 2- and 10-year Treasury yield is only about 20 basis points against a longer-term average of around 90. While the yield for both has risen, short-term rates have risen faster, anticipating a fast-paced cycle of Fed rate hikes. The 10-year Treasury seems to be signaling an ultimately slower outlook for growth and perhaps some concern that rate hikes will curtail the economic recovery. We think it's too early to interpret with confidence exactly what signal the yield curve is sending. The Treasury market is grappling with a confluence of factors that combine to create too much uncertainty: the potential impact of the war on growth and inflation, the impact of the change in monetary policy, including, importantly, the unwinding of the Fed's massive balance sheet. Further, although the yield curve has had some predictive power with respect to recessions, the timing between inversion and the recession can be long and variable. We think the curve will stay flattish and could even invert amid all of the uncertainty. We will be looking at the economic data carefully, however, and both the data and our forecast suggest that a U.S. recession remains unlikely.